Most investors think a good portfolio has to be complicated. Lots of stocks, different ETFs, crypto, gold, bonds. But what if I told you that one single ETF could replace your entire portfolio? One fund, thousands of companies, the entire global market. No constant analysis, no trading, no trying to time the market. Today, we'll break down what an ETF actually is, how the One ETF portfolio strategy works, which ETF many investors use for this strategy, and how much money it could potentially grow over time. And by the end of this video, you'll understand why many investors believe that simple portfolios often outperform complex ones. Why most investors underperform the market. When people start investing, they usually make the same mistake. They try to beat the market. They pick individual stocks. They follow financial news. They watch analyst predictions. But the problem is that the stock market is one of the most competitive environments in the world. In the market, you have investment banks, hedge funds, algorithmic traders, thousands of professional analysts, and all of them are trying to do the exact same thing: find undervalued investments. Because of this, the probability that the average investor will consistently outperform the market is extremely low. Research shows that roughly 80 to 90% of active investors underperform the market over the long term. And this happens for several reasons. The first reason is emotions. When markets are rising, people tend to buy near the top. When markets fall, people panic and sell. The second reason is too much trading. Every trade means commissions, taxes, the risk of making mistakes. And the third reason is market timing. Investors try to guess when to buy and when to sell, but even professional investors rarely do this successfully. What is an ETF? This is exactly why more and more investors are turning to ETFs. ETF stands for Exchange Traded Fund. Simply put, an ETF is an investment fund that trades on the stock exchange just like a regular stock. But there's one important difference. When you buy a stock, you buy one company. When you buy an ETF, you buy a basket of companies. Sometimes dozens, sometimes hundreds, and sometimes thousands of companies at once. Most ETFs simply track a specific index. For example, S&P 500 includes 500 of the largest companies in the United States. MSCI ACWI includes companies from across the world. FTSE Global All Cap Index tracks almost the entire global stock market. An ETF simply replicates the structure of the index, so investors automatically get a diversified portfolio. The philosophy of passive investing. The idea of investing in index funds became popular largely thanks to a man named John Bogle. He founded Vanguard and created one of the first index funds. His philosophy was very simple. Instead of trying to beat the market, it's often better to own the entire market. Because the stock market is essentially a reflection of the global economy. When the economy grows, companies generate more profits. New technologies emerge. New businesses are created. And investors who own the market participate in that growth. Even legendary investor Warren Buffett has repeatedly said that most people would be better off simply investing in low-cost index funds. The One ETF Portfolio concept. Based on this philosophy, a strategy called the One ETF Portfolio has become increasingly popular. The name is pretty self-explanatory. It's an investment portfolio that consists of just one ETF. But that ETF needs to meet several criteria. First, it should provide broad diversification. It should include thousands of companies. Second, it should ideally provide global market exposure. That means not just investing in the United States, but across multiple countries. Third, it should have low fees, because fees have a significant impact on long-term returns. That's why investors often compare three specific ETFs, three popular ETFs. Vanguard Total World Stock ETF. This ETF invests in almost the entire global stock market. It contains roughly 9,000 companies. Inside the fund, you'll find companies from the United States, Europe, Japan, China, emerging markets. This means investors get true global diversification. Vanguard Total Stock Market, ETF. This ETF is also extremely popular. However, it invests only in the United States. It contains around 4,000 American companies. These include companies like Apple, Microsoft, Nvidia, and thousands of others. The main limitation is that investors get exposure to only one country. iShares MSCI ACWI ETF. This ETF also invests globally. However, there are a few differences. It contains roughly 2,500 companies, and its expense ratio is noticeably higher. Because of this, many investors prefer another option. Why many investors choose VT? There are several reasons. The first is maximum diversification. VT contains around 9,000 companies. For comparison, ACWI includes roughly 2,500 companies. The second reason is complete market coverage. VT includes large cap companies, mid cap companies, small cap companies. This means investors get exposure to nearly the entire global economy. And the third reason is low cost. VT has an expense ratio of about 0.07%, which is considered very low. How much you could earn. Now let's look at the numbers. Historically, the global stock market has returned around 7 to 9% per year. Let's assume an investor invests $500 every month. If the average return is about 8% per year, then after 10 years, the portfolio could grow to roughly $91,000. After 20 years, about $294,000. After 30 years, approximately $745,000. And all of this is driven by compound interest. Compound interest means that your returns begin generating additional returns. Over time, the growth of the portfolio accelerates. Example of 3 investors. Let's imagine 3 investors. The first is Alex. He constantly searches for the best individual stocks. He reads financial news, follows analysts, and frequently changes his portfolio. The second investor is Maria. She builds a complex portfolio using multiple ETFs, but she has to regularly rebalance her portfolio. The third investor is Igor. He invests in one global ETF and simply adds money every month. Over 20 to 30 years, his portfolio grows along with the global economy. Downsides of the strategy. Of course, this strategy isn't perfect. The first downside is that you probably won't outperform the market. Your returns will be roughly equal to the market itself. The second downside is that markets sometimes fall. For example, during the 2008 financial crisis or during the COVID-19 market crash. However, historically, the market has always recovered over time. Investing doesn't have to be complicated. Sometimes the best portfolio is actually the simplest one. A single ETF can give you thousands of companies, global diversification, exposure to the growth of the world economy, and most importantly, a strategy that's easy to follow for decades.